Japan, the land of the rising sun, has just made a move that's sending shockwaves through the global economy. In a bold and unexpected decision, Japan is ditching the US dollar, selling off its treasury holdings, and standing up against Trump's tariffs. What does this mean for the US economy, the dollar's dominance, and the future of global trade? Let's dive in. For decades, US Treasuries were considered the gold standard of global finance, a symbol of safety and stability. But now, a wave of bond sales from 16 allied nations, ranging from Japan and Saudi Arabia to even Britain, suggests that Washington's long-standing credibility may be under scrutiny. Some are beginning to wonder if the world's largest economy, the cornerstone of the petrodollar system, is facing a rupture that would have seemed unthinkable just a few years ago. Could this be the first real sign that America's unmatched energy dominance and financial power are entering a new phase? Interest rates are climbing, US public debt continues to swell, and allies who once eagerly held vast amounts of US bonds now appear to be exploring safer or more profitable alternatives. Is this merely a reaction to short-term market volatility? Or could it signal the start of a broader shift away from the dollar-based system as Washington attempts to project confidence, the allure of alternative reserves, gold, the yuan, even cryptocurrencies, is capturing increasing global attention? Saudi Arabia's pivot toward China, Japan's portfolio realignment, and the UK's post-Brexit financial strategies are all converging, creating a complex challenge to American hegemony. The critical question is whether these bond sales will escalate into a full-blown crisis, driving up America's borrowing costs and spreading uncertainty far beyond its borders. Let's take a closer look behind the scenes of this dramatic development. For years, US Treasuries were regarded as the world's safest haven, with allied nations like Japan, Saudi Arabia, and the United Kingdom holding vast amounts of US bonds. These holdings not only secured their reserves, but also reinforced their strategic ties with the United States. However, recent data has turned this picture on its head. Japan's bond reserves are shrinking rapidly. Saudi Arabia is reportedly offloading its holdings amid political tensions with the US, and even close allies like the UK are following a similar trend. What's driving this sell-off? The first and most obvious reason is the growing US budget deficit and its massive public debt burden. Concerns about the reliability of US Treasury bonds, a topic that has surfaced repeatedly in the past, are once again taking center stage. Some experts argue that as interest rates rise, the value of existing bonds falls, prompting countries to sell to avoid losses. Others warn that confidence in the dollar-based system is eroding, pushing the world to explore alternative reserves. There are even reports suggesting that Saudi Arabia is questioning the future of the petrodollar system. So, how does the Federal Reserve's high-interest rate policy impact bond holdings? While the Fed raised rates to combat inflation, expecting the dollar to strengthen, the declining value of bonds has made this strategy less appealing. Higher interest rates tend to depress the prices of existing bonds, and even though nominal yields may rise, investors facing short-term losses are increasingly wary. This dynamic is reshaping global financial strategies and raising questions about the long-term stability of the dollar's dominance. If this situation persists, it might be wise to consider selling bonds and exploring alternative investments. Across many countries, discussions about shifting to non-dollar assets are gaining momentum. Gold reserves, yuan holdings, and even cryptocurrencies are increasingly being seen as viable options. What began as concerns are now translating into concrete actions. The collective bond sales by 16 allied nations have sparked a sense of unease in the United States. This wave of sales resembles an economic and diplomatic snowball effect. Once one country starts, others may follow, driving up US borrowing costs and potentially triggering a public budget crisis. While some still argue that the US dollar remains the world's reserve currency and cannot be entirely abandoned. Several factors are undermining trust. The ongoing debt ceiling debates between 2023 and 2025, the Biden administration's spending policies, and Washington's unpredictable foreign policy decisions are creating doubts even among allies. The long-held belief that America is a safe haven is being challenged, leaving many feeling less secure than before. The political dimension adds another layer of complexity. Saudi Arabia, for instance, has historically viewed its US bond holdings as strategic leverage, thanks to its oil-dollar partnership with Washington. However, recent tensions over OPEC Plus policies, human rights issues, and regional conflicts have driven Riyadh to distance itself from the US. This sentiment is spreading across Gulf nations like the UAE and Qatar, where there's growing interest in strengthening ties with China and Russia. It's becoming clear that dollar bonds are no longer seen as indispensable. Japan presents a different dynamic. For years, it was the largest buyer of US bonds, even as the yen weakened. But now, Japan's economic revitalization policies, increased defense spending, and the rising interest rate environment may be pushing Tokyo to reduce its bond holdings. Additionally, the US's tough stance on China in the Asia-Pacific region is straining regional balances. While Japan remains a critical US ally, it seems to be adopting a more diversified portfolio strategy, raising questions about whether this shift is purely economic or carries a political message. Even the United Kingdom, often seen as America's closest ally, is part of this trend. Post-Brexit, London is working to strengthen its financial centre and diversify its investments. Selling US bonds and exploring alternative channels may be more about adapting to economic realities than a loss of trust in the US. However, some analysts argue that, in the bigger picture, this reflects a broader reevaluation of global financial strategies. In essence, the world is at a crossroads. The US dollar's dominance is being tested, and the actions of these 16 allied nations could signal the beginning of a significant shift in the global financial order. Whether this leads to a full-blown crisis or a gradual rebalancing remains to be seen, but the implications are far-reaching. Europe and the United Kingdom are no longer as reliant on US global leadership as they once were. Given these developments, the question arises: how will Washington respond? The US Treasury Department urges calm, emphasizing that the US still boasts the deepest and most liquid bond market in the world, and that minor fluctuations are normal. But is the simultaneous divestment by 16 countries just a small ripple, or the precursor to a seismic shift? While these nations aren't coordinating in a synchronized operation, the timing of their actions has created a cumulative wave of bond selling, sparking unease in financial markets.